Welcome to another deep dive.
Yeah.
You ready to get intelligent about investing?
I'm always ready for that.
Today,
Yeah.
we're going to crack open Benjamin Graham's legendary book, The Intelligent Investor.
It's a classic for a reason.
Oh, yeah. And we're going to uncover some seriously fascinating stuff.
Okay.
So get this right. Graham turned $65
Right.
into $110
All right.
in just 3 years.
Not bad.
How'd he do it?
How?
He found a hidden treasure
Mm-hmm.
in this company, Northern Pipeline Co.,
Okay.
just by pouring through these really detailed financial reports.
The ones that most people just skip over.
I'm guilty of that.
Oh, yeah. We've all been there.
So right off the bat,
Yeah.
Graham busts this myth that intelligent investing is about having like a genius-level IQ.
Yeah, it's not about being a brainiac.
Right.
It's about developing the right mindset,
Okay.
the right character traits.
Like what?
Patience, discipline, a thirst for knowledge, and the ability to think for yourself and control your emotions.
That's huge.
Oh, absolutely. Those emotions can really lead you astray when it comes to investing.
So you're saying, like, don't follow the herd.
Exactly. Think for yourself.
Don't get swept up in the hype.
Yeah, don't let fear or greed cloud your judgment.
Okay, so who was this Benjamin Graham guy?
Yeah.
Was he just some, like, ivory tower academic?
Not at all. In
Okay.
fact, after ditching academia for Wall Street, he became known for this super meticulous approach to stock analysis. Like a master of digging into those financial reports and just like squeezing out all the valuable insights that other people just totally missed.
Like with the Northern Pipeline story.
Exactly.
What did he actually find in those reports?
So he realized that Northern Pipeline was sitting on a pile of high-quality bonds worth way more than the company's stock price at the time. So he bought up a bunch of the stock. He encouraged the management to, raise the dividend and ended up making a really nice profit just a few years later.
That's a fantastic example.
Yeah, it really shows you the power of research, digging deep and not just relying on those hot stock tips.
Right. And, Graham, he's super clear about this distinction between investing and speculating.
Absolutely.
He actually cautions against getting swept up in those hot stock tips.
Yeah, especially if you're not a seasoned investor.
Right. If you're new to the game,
Exactly.
don't go chasing those risky bets.
Yeah. And he also advises against operating on margin,
Which is good.
borrowing money to buy stocks.
Okay. Can you unpack that a little bit?
Yeah, so it can amplify your gains if things go well, but it also magnifies your losses if things go south.
Right. So you're essentially taking on more risk.
Exactly. And that can be dangerous if you're not prepared for it.
Okay. So that's speculating.
Yeah.
Let's talk about another thing that Graham says to be really cautious about,
Okay.
which is trying to time the market.
Oh, yeah, that's a tough one.
So are you saying that even the pros have a hard time predicting those short-term market movements?
It's really difficult to consistently predict where the market's going in the short term.
Okay.
There are so many factors at play.
I can imagine.
Even the most seasoned professionals get it wrong all the time.
So like a Duke University study.
Yeah, the study was really interesting. It found that people who followed market timing newsletters,
Okay.
they actually ended up with lower returns
Yeah.
than if they had just invested in a simple index fund.
So those newsletters are basically worthless.
Well, they can be misleading because they often make it seem like timing the market is easy,
Right.
but in reality, it's incredibly difficult.
So trying to time the market is basically like trying to catch lightning in a bottle.
It's like trying to predict the future.
Yeah.
Hindsight is 20/20, but foresight is a whole different story.
That's a good one. So if trying to time the market is a recipe for disaster.
Yeah, it often leads to more anxiety and regret than actual profits.
So what's the alternative?
Well, Graham recommends a much more sensible approach,
Okay.
which is to build a balanced portfolio.
Okay.
He suggests aiming for roughly a 50-50 split between stocks and bonds.
Okay, so a classic balanced portfolio.
Exactly.
Why is that so important?
Well, for a few reasons.
Okay.
First, it helps you stay disciplined.
Okay.
Second, it prevents you from getting too exposed to the ups and downs of the stock market. And third, it gives you a kind of psychological advantage.
How so?
Well, by having a portion of your portfolio in bonds,
Mm-hmm.
which are generally more stable than stocks,
Okay.
you're less likely to panic and make rash decisions when the market inevitably takes a dip.
Right, so it's about managing those emotions.
Exactly.
Which we've already said are so crucial for intelligent investing.
Absolutely.
So we've got our balanced portfolio.
Yeah.
How do we go about actually selecting the right stocks?
All right, that's the million-dollar question.
Yeah.
Graham advises defensive investors to steer clear of what are often called growth stocks.
Okay, so those are typically the companies that are expected to grow at a really rapid pace.
Exactly.
Okay, but why would he suggest avoiding them?
Well, because while they have the potential for really high returns, they're also incredibly volatile and unpredictable.
So it's a bit of a gamble.
It can be, and for a defensive investor, that level of risk is usually not worth it.
Okay, so where should a defensive investor be focusing their attention then?
Graham suggests looking for large, well-established companies that are currently out of favor with the market.
Okay, what do you mean by out of favor?
Companies that are undervalued.
Okay.
That the market is kind of overlooking for whatever reason.
Interesting.
They might not be the most exciting companies.
No.
But they offer a good balance of potential and safety.
So it's kind of like finding those hidden gems in a bargain bin.
That's a great way to put it.
You're looking for those diamonds in the rough.
Exactly. You're looking for companies that have solid fundamentals, but that are being overlooked by the market because they're not the flashiest or the trendiest.
So you're saying don't follow the hype.
Exactly. Do your research.
Okay.
Find those undervalued companies.
Right.
And let the market catch up to their true worth.
Which brings us to another key element of Graham's philosophy.
Okay.
Patience.
Oh, yeah. Patience is crucial in investing.
And he has that famous analogy of Mr. Market, right?
Exactly.
Can you remind us who Mr. Market is?
So Mr. Market represents the stock market.
Right.
He's this moody, unpredictable, often irrational character.
Sounds a little bit like me when I'm hungry.
Well, we all have a bit of Mr. Market in us.
Yeah.
He'll offer to buy your stocks at ridiculously low prices one day.
Okay.
And then try to sell them back to you at inflated prices the next.
Sounds like he needs some therapy.
Yeah. Maybe. So, but the point is, we shouldn't let his mood swings dictate our investment decisions.
Okay.
Don't let him manipulate you.
Right.
Focus on the long-term value of the businesses you own and try to tune out all that market noise.
Right.
Because remember, the market is often irrational in the short term, but over time, it tends to reflect the true value of a company.
So the key takeaway here is that we need to be patient. We need to focus on the fundamentals.
Exactly.
And we need to remember that. In the words of the great Warren Buffett, the stock market is a device for transferring money from the impatient to the patient.
Couldn't have said it better myself.
So are you saying that patience is not just a virtue in investing? It's actually the key to success.
I think that's a fair assessment.
All right. So we've got patience. We've got a balanced portfolio.
Yeah.
We're focusing on those undervalued. Large, well-established companies.
Okay.
And we're not trying to time the market.
Sounds like a solid plan so far.
Yeah. So what else does Graham have in store for us?
Well, he actually delves into some other interesting areas like preferred stocks.
Okay.
But he points out that there are some tax implications that people might not be aware of.
Okay, break it down for me. What's the deal with preferred stocks and taxes?
So preferred stocks have this better tax status for corporations than for individual investors.
Right.
So corporations, they only pay income tax on a small portion of the dividends they receive from preferred stocks.
Okay.
But for individuals, it's a different story.
How so?
Well, they end up paying the same tax rate on those dividends as they would on regular bond interest.
Interesting. So you're saying that if I'm an individual investor, I might want to think twice before diving headfirst into preferred stocks.
Exactly. You might want to explore other investment options that are more tax efficient.
That makes sense now. Another thing Graham talks about is inflation.
Yeah, inflation is a big concern for investors.
Especially these days, right? It's been on everyone's mind.
It's eating away at our purchasing power.
Yeah. So what does the Graham have to say about that?
So he actually delves into a century of stock market history.
Okay.
And he points out that even though stocks are generally considered a good hedge against inflation, there have been times when they've actually failed to keep pace with rising prices.
Interesting. So even stocks aren't a foolproof protection against inflation.
Exactly. That's why it's important to have a diversified portfolio.
Okay.
And to consider other investment options.
Right.
Like, for example, TIPIAs.
What are those?
Treasury inflation-protected securities.
Correct.
They're a type of bond issued by the U.S. government.
And how do they work?
So Their principal value actually adjusts with inflation.
Okay.
So if inflation goes up, the value of your TPS goes up along with it.
So it helps to preserve your purchasing power.
Exactly.
Interesting. I hadn't heard of those before.
Yeah, they can be a really useful tool for investors.
Okay, so we've got some new tools in our arsenal, and we're being mindful of inflation.
Absolutely.
What else does Graham talk about?
Well, he also delves into the psychology of investing.
Right.
And he talks about some of the psychological traps that investors can fall into.
Yeah, I'm sure we're all guilty of some of those.
I know.
He actually has a really cool phrase for it.
What's that?
The rule of opposites.
Oh, yeah, that's a good one.
Can you explain what that means?
So basically, he observed that the more enthusiastic investors get about the stock market, the more likely they are to be proven wrong.
So when everyone's overly optimistic,
yeah,
that's often a sign that trouble's brewing.
Exactly. It's a classic case of buying high and selling low.
Right, which is the exact opposite of what we want to do.
We want to buy low and sell high.
Yeah, that makes sense.
It's a lot easier said than done, though.
Oh, absolutely. Our emotions can really get the best of us.
They can, and that's why Graham emphasizes the importance of staying grounded.
Okay.
And not getting carried away by the euphoria of a bull market. Or the panic of a bear market.
Right, so it's all about staying level-headed.
Exactly.
And making rational decisions based on the facts.
Yeah. Don't let your emotions cloud your judgment.
So what are some practical strategies for avoiding those emotional pitfalls?
Well, Graham suggests focusing on what you can control.
Okay.
You can't control what the market does in the short term, but you can control your own behavior.
Okay.
You can choose to make rational, well-informed decisions based on solid research and a long-term perspective.
So it's about taking a step back.
Yeah.
Looking at the bigger picture.
Exactly.
And not getting bogged down in the day-to-day fluctuations.
Yeah, those short-term movements are often driven by noise and speculation.
Right.
Not by any real changes in the underlying value of the businesses.
So we need to filter out that noise.
Exactly. Focus on the fundamentals.
And this brings us back to that concept of margin of safety.
It's one of Graham's most important principles.
Can you remind us what it is and why it's so important?
Yeah, so margin of safety is basically buying stocks at a price that is significantly lower than their intrinsic value.
Okay, so it's like getting a discount.
Exactly.
And that discount acts as a buffer.
Yeah, it creates a cushion.
Against the unexpected.
Exactly. Even if your assessment of a company's value turns out to be a bit off, you still have that margin of safety to protect you from big losses.
So how much of a margin of safety should we be aiming for?
Graham actually suggests aiming for at least 50%.
Wow, okay.
That means buying a stock for $50 that you believe is actually worth $100.
Okay, that's a pretty substantial discount.
It is, but remember, the bigger the margin of safety, the lower your risk.
All right, so margin of safety is key.
Yeah, it's a fundamental principle of value investing.
And how do we actually go about finding that margin of safety?
Well, that's where careful analysis comes in.
Okay.
It involves looking at a company's financial statements, understanding its industry, projecting its future earnings and cash flows.
So no easy answers there?
No, it takes work.
Okay.
Research and judgment.
Okay.
But the good news is you don't have to be a Wall Street wizard to understand the basics of valuation.
Okay.
Graham provides some really straightforward tools and techniques that any investor can learn and apply.
So we're not talking about rocket science here.
No, it's about understanding the basic principles of business and finance and applying them to your investment decisions.
So it's about being a smart and patient investor.
Exactly.
I like it. And Graham really emphasizes the importance of doing your own homework.
Oh, absolutely. He's not a fan of blindly following investment recommendations.
Right. So he's saying don't just trust what some broker or financial advisor tells you.
Exactly. Do your own research. Think for yourself.
Right.
Don't just take someone else's word for it.
Okay, so what are some questions that an intelligent investor should be asking their financial advisor?
Well, you should definitely ask about their qualifications.
Okay.
How they choose investments. What their track record is.
Right.
How they handle underperforming investments.
Yeah, and how they're compensated.
Absolutely. You want to make sure their incentives are aligned with yours.
Right. You don't want them just trying to sell you products.
Exactly.
And generate the highest commissions for them.
That's a recipe for disaster.
Exactly.
Yeah.
So it's all about transparency and trust.
Absolutely. You need to have a strong relationship with your financial advisor.
Right.
Built on open communication and mutual respect.
And Graham also cautions against getting caught up in those latest investment fads or trends.
Oh, yeah, those can be dangerous.
Yeah.
He's particularly wary of those new era stories that promise unrealistic returns.
You know, like, we've heard those stories before.
Oh, yeah, we hear them all the time.
Like the dot-com boom.
Yeah.
This is supposed to be a new era. The housing bubble. That's supposed to be a new era.
And then there was the cryptocurrency craze.
Right.
It seems like there's always a new shiny object that promises to make everyone rich.
Yeah, and those promises often turn out to be empty.
They often do.
Right. So what does Graham suggest as a more reliable approach to selecting investments?
Well, he advocates for a value-oriented approach.
Okay, so what does that mean?
It means looking for companies that are trading at a discount to their intrinsic value.
Okay.
Companies that have solid fundamentals, but that are being overlooked by the market.
So it's kind of like being a financial detective.
I like that analogy.
You're looking for clues that indicate a company might be worth more than its current price.
You're trying to uncover value that others are missing.
I like it. So Graham provides some specific tools and techniques for analyzing a company's financial statements.
Absolutely.
Assessing its management team and evaluating its competitive position.
Yeah, all of those things are crucial.
So this is where those detailed reports we talked about earlier come in handy.
They do.
Right, the ones that most investors wouldn't even bother to look at.
Exactly. It's about going beyond the headlines and really understanding the business.
Right.
So you can make an informed judgment about its true worth.
Okay, so we've got to dig deep, do our research, and form our own independent judgment.
Exactly.
And that's what it means to be an intelligent investor.
It's not about following the crowd.
Right.
It's about thinking for yourself.
I like it. I like it.
And making your own decisions based on your own analysis.
All right, so stay tuned for part 2 of this deep dive.
Yeah, we'll be back soon with more insights from the intelligent investor.
Can't wait.
Me neither.
It's human nature, isn't it?
Oh, absolutely.
When the market's soaring, we want to buy more.
We get greedy.
Even as prices are already way up there.
That's right. We think it's just going to keep going up forever.
Right, and then when it crashes, we panic.
Yep, we sell everything.
Even if it means locking in those losses.
Yeah, fear takes over.
It's like we're constantly battling those instincts.
That's exactly what Graham recognized. He understood the power of emotions.
Right.
And how they can lead us to make some really bad decisions.
So how do we overcome those emotional impulses?
Well, one key is to have a plan.
Okay.
A disciplined investment plan.
Right.
And stick to it no matter what's happening in the market.
So don't get swayed by those short-term fluctuations.
Don't let the market noise distract you.
Stay focused on the long term.
That's the key. Remember, the market is a voting machine in the short run.
Okay.
But in the long run, it's a weighing machine.
Meaning?
In the short term, the market reflects the whims and emotions of the crowd.
Okay.
But over time, it reflects the true value of the businesses.
So don't let the short-term noise drown out the long-term signal.
That's right. Focus on the fundamentals.
Which reminds me of that concept we talked about, margin of safety.
Oh, yeah, that's a crucial one.
Can you remind us what that is?
Sure. So margin of safety is the difference between the price you pay for an investment and its intrinsic value.
Okay, so it's like a buffer.
Yeah, like a cushion.
Against unexpected
problems. It protects your capital.
Okay, think of it like buying a house.
Okay.
You wouldn't want to pay the absolute maximum price, right?
No, you'd want some room for negotiation.
Right, you'd want some protection.
Exactly.
In case the appraisal comes in lower than expected.
That's a great analogy. It's the same principle with investing.
So you're saying be conservative, be patient, and wait for those opportunities when the market offers up a bargain.
You want to buy assets at a price that's significantly lower than what you believe they're truly worth.
Okay, so how big of a margin of safety should we be aiming for?
Well, Graham actually suggests aiming for at least 50%.
Wow, 50%?
That means buying a stock for $50. Okay.
That you believe is actually worth $100.
Okay, that's a pretty big discount.
It is, but the bigger the margin of safety, the lower your risk.
I got it. But how do we determine that intrinsic value?
Well, that's where careful analysis comes in. It involves looking at the company's financial statements.
Right.
Understanding its industry.
Okay.
Projecting its future earnings and cash flows.
So there's no crystal ball.
No magic formula.
It takes work.
It does.
Research and judgment.
Exactly. But the good news is You don't have to be a financial wizard to do it.
Okay.
Graham lays out a framework that any investor can learn and apply.
So it's about understanding the fundamentals.
Exactly.
And applying those fundamentals to your investment decisions.
That's the key to intelligent investing.
Okay. Graham also talks a lot about the importance of thinking for yourself.
Oh, yeah, that's a big one.
He doesn't want us to just blindly follow the crowd.
No, he was a true contrarian.
He believed that the greatest investment opportunities often arise when the crowd is panicking.
When everyone's running for the exits.
Exactly. That's when you can find the real bargains.
So it's about having the courage to go against the grain. To think differently.
And to see value where others don't.
Exactly.
But that can be tough.
Oh, it definitely can.
Especially when everyone around you
seems
to be making money on a particular investment.
It's easy to get caught up in the herd mentality.
So how do we resist that urge?
Well, Graham reminds us that those who achieve extraordinary returns are often those who are willing to be different, to think independently, and to act when others are hesitant.
So it's about having the confidence to trust your own judgment.
Exactly, even when it goes against the prevailing sentiment.
And that requires doing your own research.
Absolutely.
Developing your own investment philosophy and making decisions that align with your own goals and risk tolerance.
That's the key to becoming an intelligent investor. Okay, so let's talk about financial news. It feels like we're bombarded with it these days.
Oh, absolutely. It's everywhere.
TV, internet, social media.
It's a constant barrage of information.
It's hard to know what to believe.
And who to trust.
So how do we navigate this sea of information?
Well, Graham was very wary of the financial media. He believed that much of what's reported is just noise.
Noise meaning?
It's designed to generate excitement, attract eyeballs, rather than provide real insight.
So you'd be careful.
Absolutely be discerning about the information you consume.
Right.
Don't just blindly accept everything you read or hear.
So question the motives of the source.
Exactly.
Consider the biases that might be at play.
And always do your own research.
Okay.
Before making any investment decisions based on what you've seen in the news.
So be critical, be skeptical.
Yeah. And remember, the most valuable insights often come from digging deep.
Okay.
Reading those detailed financial reports. Understanding the nuances of a business.
Right.
And developing your own informed perspective.
So it's about being an active participant.
Exactly.
In your own financial education.
You're not just a passive recipient of information.
Okay. Now, we've talked a lot about the analytical side of intelligent investing. But Graham also emphasizes the importance of character.
Oh, absolutely.
Of developing the right mindset.
He believed that temperament is just as important as intellect when it comes to investing.
So it's not just about being smart.
No, it's about being disciplined, patient, emotionally resilient.
Right.
Those qualities are essential for long-term success in the market.
So how do we cultivate those traits?
Well, it starts with understanding ourselves.
Okay.
Recognizing our own biases and weaknesses.
Right.
And developing strategies for mitigating their impact on our decision-making.
So, for example, if I know that I tend to get overly enthusiastic about the market when it's going up, I might set some rules for myself.
That's a great idea.
Like limiting the amount I invest in any one stock or sector.
Having rules can help you stay disciplined and avoid making those emotional decisions.
Or if I know that I tend to panic and sell when the market takes a dip, I might want to have a plan in place for riding out those downturns.
Like maybe remind yourself of your long-term investment goals.
Right.
Or diversify your portfolio.
To reduce my exposure.
Yeah, to any one asset class.
So it's all about being self-aware. Being proactive.
Exactly.
And developing those habits and routines.
Yes.
That will help us stay on track.
And avoid those emotional pitfalls that can really hurt our returns.
Right, because those emotions can lead us astray.
Oh, they definitely can.
And Graham also talks about the importance of learning from other successful investors.
Oh, absolutely. He believed that we can gain valuable insights from studying the methods and principles of those who have achieved extraordinary results.
So it's like learning from the masters.
Exactly. He points to investors like John Templeton and Philip Fisher, who were known for their rigorous research, their independent thinking, and their long-term perspective.
So what can we learn from them?
Well, Templeton was a master of finding undervalued assets
Okay.
in overlooked markets around the world.
So he was a global investor.
Yeah, he was a pioneer of global investing, and he believed that diversification across different countries and different asset classes was essential for managing risk and achieving superior returns.
So don't be afraid to look beyond our own borders.
There are opportunities all over the world.
Okay, and what about Philip Fisher?
Well, Fisher was known for his focus on growth companies, but not just any growth companies.
Right.
He looked for companies with strong management teams, innovative products or services, and a durable competitive advantage.
So he was looking for companies that were built to last.
Exactly. He believed that finding those exceptional businesses and holding them for the long term was the key to building real wealth.
So it's about finding those companies that are not just growing rapidly, but that also have a sustainable edge in the marketplace.
That's the key to long-term success in investing.
All right, so we've got Templeton with his global perspective and Fisher with his focus on those exceptional growth companies.
Yeah, and of course, Graham had his own unique approach.
Right.
But he recognized that there's no one-size-fits-all formula for success.
Right, so it's about finding what works for you.
Exactly.
What resonates with your own style and beliefs, and then applying those principles consistently and with discipline.
That's the key to success in investing.
Okay, so find your own path and stick to it.
Exactly.
Now, one of the things that can be challenging for new investors is knowing where to get reliable information.
Oh, absolutely. There's so much information out there. It can be overwhelming.
It's hard to know who to trust.
And what to believe.
So where do we start?
Well, I always recommend starting with the classics. Like Graham's book, The Intelligent Investor.
Of course.
It's considered the Bible of value investing for a reason.
Yeah.
It's full of timeless wisdom and practical advice.
Okay.
That's as relevant today as it was when it was first published.
Absolutely a must-read for any serious investor.
Agreed. And if you want to delve deeper into the technical aspects of valuing a business, I highly recommend Security Analysis by Graham and Dodd. Yeah. And for insights into the thinking of one of the most successful investors of all time, check out the essays of Warren Buffett.
Great suggestions. And what about websites?
Oh, there are tons of great websites out there.
Any favorites?
Well, for analyzing stocks and mutual funds, I like Morningstar and Value Line.
Okay.
And for a more general overview of financial topics, Investopedia and The Motley Fool are great resources.
Okay, so plenty of resources out there to help us on our journey to becoming intelligent investors.
Exactly.
And, you know, Graham also talks a lot about the psychological side of investing.
Yeah, that's a crucial aspect.
And he says we're all susceptible to these biases.
We are.
Like overconfidence, confirmation bias.
And loss aversion.
Okay, can we break those down a bit?
Sure.
So what is overconfidence bias?
Overconfidence bias is basically the tendency to overestimate our own abilities and knowledge.
So we think we're smarter than we actually are.
That's right. And it can lead us to make some really bad decisions.
Like what?
Like making impulsive trades, chasing hot stocks, ignoring warning signs.
Because we think we know better?
Exactly.
So we need to be humble.
We do. We need to recognize that we don't have all the answers.
Right.
And that the market can be unpredictable.
Okay, what about confirmation bias?
So confirmation bias is the tendency to seek out information that confirms our existing beliefs and to ignore information that contradicts them.
So if I've already decided that I want to invest in a company, I'm going to focus on the positive news.
You're more likely to see what you want to see.
Right.
And to ignore any red flags.
So I need to make a conscious effort to consider all sides before making a decision.
Okay. And what about loss aversion?
Loss aversion is the tendency to feel the pain of a loss more strongly than the pleasure of an equivalent gain.
So we hate losing more.
We do.
Do we love winning?
It's wired into our brains.
So how does that affect our investment decisions?
Well, it can lead us to hold on to losing investments for too long.
Hoping they'll come back.
Exactly. Or to sell winning investments too early.
Fearing that we'll give back our gains.
That's right.
So how do we overcome these biases?
Well, one strategy is to develop a set of investment principles or rules that we can follow consistently.
Regardless of our emotions.
So if I've decided I'm going to invest in companies with a strong track record of profitability and a low debt-to-equity ratio, I should stick to those criteria.
You should.
Even when I'm feeling tempted to chase a hot stock.
Exactly. Having a set of rules
Right.
can help you stay disciplined and avoid making those impulsive decisions.
That are driven by
fear and greed.
Okay, so rules are good.
Rules are good.
Now, what about professional investors? Do Graham's principles apply to them?
Absolutely. In fact, he was particularly critical
Okay.
of the way many professional investors operate.
Really? Why is that?
Well, he believed that many fund managers are too focused on short-term performance,
Okay.
too quick to chase trends, and too willing to take excessive risks with their clients' money.
So they're not always acting in the best interest of their clients.
They're often more concerned with beating the market in the short term than with generating long-term value.
So how do we as individual investors know which professional investors to trust?
That's a great question, and it's not always easy to answer.
Yeah.
But there are some things you can look for.
Okay.
First, look for managers who have a long-term track record of success.
Okay, so not just a hot streak.
No, you want to see consistent outperformance over a period of years.
So patience is key here as well.
Absolutely.
What else?
Second, look for managers who have a clear and consistent investment philosophy. Do they have a well-defined approach to investing?
Okay.
Do they articulate their strategy in a way that you can understand?
So they're not just winging it.
No, they have a plan and they stick to it.
Okay. What else should we look for?
And third, look for managers who are transparent and accountable.
So what does that mean?
Do they communicate openly with their investors? Do they provide clear and detailed reports on their performance?
Okay.
Do they have a strong track record of ethical behavior?
So transparency, integrity, and accountability.
Those are essential qualities to look for in any financial professional.
Right. You're entrusting them with your hard-earned money.
Exactly. You need to be confident that they're acting in your best interests.
Now, Graham talks a lot about the importance of value investing, of finding those undervalued assets that the market has overlooked.
But how do we know if an asset is truly undervalued?
That's a great question.
That's where the concept of intrinsic value comes in.
Okay. Remind us what that is again.
So intrinsic value is the true worth of an asset.
Okay.
Based on its underlying fundamentals. Its earnings, its assets, its future prospects.
It's about looking beyond the market price.
Exactly.
And trying to determine...
Yeah, what's the asset actually worth?
Yeah, what's the asset actually worth?
But how do we calculate that?
Well, it's not an exact science.
Right.
It requires judgment, research, and a deep understanding of the business and its industry.
Okay, so no easy answers there.
No, but Graham provides some guidelines and techniques for estimating intrinsic value. Okay, and he emphasizes the importance of using...
a margin of safety.
There it is again, that margin of safety.
It's one of the most important principles for managing risk.
Can you give us an example?
Sure, let's say you're looking at a stock that's trading at $50 per share. And you estimate its intrinsic value to be $100 per share.
Okay.
That would be a margin of safety of 50%.
Meaning?
You're buying the stock at a 50% discount to its true worth.
And that reduces my risk.
It does, because even if your estimate of intrinsic value is a bit off, you still have that cushion to protect you from a big loss.
Okay, so estimating intrinsic value, it takes work.
It does.
It takes judgment, and it takes a deep understanding of the business.
But it's a crucial skill for any value investor.
Okay, Graham also talks about the importance of being patient.
Oh, yeah. Patience is key in investing.
And he's wary of those get-rich-quick schemes.
Absolutely. Those are almost always scams. He believed in the power of compounding, of letting your investments grow over time.
So don't expect overnight riches.
No. Building wealth takes time.
Okay.
Patience and discipline.
Right, and he compares building wealth to planting a tree.
That's a great analogy.
You don't plant a tree and expect it to bear fruit the next day.
It takes time for it to grow.
Right, so it's about having a long-term perspective.
Exactly.
And trusting in that power of compounding.
And resisting the temptation to chase those short-term gains that often lead to disappointment.
Okay, now the market can be volatile.
It can be a roller coaster.
And it's easy to get caught up in that.
It is when the market's soaring.
Yeah.
We feel like geniuses.
And when it's crashing.
We feel like fools.
Right. So how do we avoid getting swept up?
Well, Graham reminds us that the market is not our friend.
What do you mean?
It's not there to guide us or to make us rich.
Okay.
It's simply a mechanism for buying and selling assets.
So don't take it personally.
Exactly. Don't let the market dictate your mood.
Or my behavior.
That's right. View the market as a tool.
Okay.
Means to an end.
Right.
And use that tool intelligently and dispassionately.
Okay, so don't get emotional about it.
Exactly.
Now, one of the things that can be challenging for investors is knowing when to buy and when to sell.
Yeah, that's the million-dollar question.
Right. When is the right time to enter the market? And when is it time to take profits?
Or cut your losses.
So does Graham have any guidance on this?
Well, he provides some guidance.
Okay.
But he emphasizes that there's no one-size-fits-all answer.
Okay.
The right time to buy or sell depends on a variety of factors.
Right.
Your investment goals, your risk tolerance, your time horizon, your assessment of the asset's intrinsic value.
So it's not about following some magic formula
No.
or listening to some talking head on TV.
Exactly.
It's about doing your own research,
Yes.
developing your own strategy, and making decisions that align with your individual circumstances.
That's the key to intelligent investing.
Okay, so Graham offers some general principles
He does.
for buying and selling. And he suggests buying when an asset is trading at a significant discount.
Okay. To its intrinsic value.
Right.
And selling when it's trading at a significant premium.
To its intrinsic value.
Exactly. Buy low, sell high.
But how do we know when an asset has reached its intrinsic value?
Well, that's where things can get a bit more complex.
Right.
Graham provides some techniques for estimating intrinsic value.
Okay.
But it's not an exact science.
Okay.
It requires judgment analysis and a deep understanding of the business.
And Graham also recognizes that there are times when it makes sense to deviate from his general principles.
He does.
So, for example, he says there may be times when it's prudent to sell a stock, even if it's not trading at a premium to its intrinsic value.
That's right.
So when might those situations arise?
Well, there could be changes in the company's management, industry, or the overall economy that cause you to reevaluate your assessment of its prospects.
Right, so it's about being adaptable.
Exactly.
Being willing to change our minds as new information emerges.
Investing is not a static process.
Right.
It's a dynamic process that requires us to constantly reassess our assumptions, our strategies, and our portfolios.
Now, Graham emphasizes the importance of being a defensive investor.
He does.
What does he mean by that?
So a defensive investor is someone who's primarily concerned with preserving capital and minimizing risk.
So they're not looking to get rich quick.
No, they're looking to build wealth slowly and steadily over time.
It's about playing the long game.
Exactly.
Taking a cautious, measured approach.
Defensive investors are patient, disciplined,
Mm-hmm.
and risk-averse.
Right.
They're not swayed by the latest fads or trends.
Mm-hmm.
They stick to their principles.
Okay.
They stick to their plan. Mm-hmm.
And they're willing to wait for the right opportunities to come along.
Okay, now he also talks about the concept of an enterprising investor.
He does.
How's that different?
So an enterprising investor is someone who's willing to take on more risk
Okay.
in pursuit of higher returns.
So they're more hands-on?
Yeah, they're more active in managing their portfolios, and they're more willing to do the research and analysis necessary to identify those undervalued assets.
So they're not afraid to roll up their sleeves?
No. They're willing to put in the work.
Okay. And which approach is better?
Well, Graham doesn't say that one is better than the other.
Okay.
The best approach for you depends on your individual circumstances,
Right.
your risk tolerance, your time horizon,
Okay.
and your investment goals.
So it's about knowing yourself.
Exactly.
And choosing an approach that aligns with your personality and your financial objectives.
That's the key to success in investing.
Okay. So no right or wrong answer. No, it's all about finding what works best for you.
Okay, now Graham offers some specific advice
He does.
on stock selection.
Yeah, he provides some criteria for identifying undervalued companies.
Okay.
And he emphasizes the importance of looking for companies with a strong track record of profitability,
Right.
a solid financial position, and a history of paying dividends.
So he's looking for those companies that are fundamentally sound.
Exactly. Companies that are well managed and that are generating real profits.
Okay.
And he believes that those types of companies are more likely to weather economic storms,
Right.
to continue growing their earnings,
Okay.
and to reward their investors over the long term.
So we're not just looking for a quick buck.
No, we're looking for long-term sustainable growth.
Okay, now before we move on, I want to revisit this concept of Mr. Market.
Oh, yeah, that's a great one.
It really illustrates how the market works.
It does. It helps us to understand the psychology of the market.
So remind us who Mr. Market is.
So Mr. Market is this, like, manic depressive fellow
Yeah.
who shows up at your door every day offering to buy your stocks.
Okay.
Or sell you his...
Right.
Some days he's euphoric, offering ridiculously high prices.
And other days he's depressed.
Yeah.
Offering to sell his stocks for pennies on the dollar.
That's right.
So he's driven by emotions.
He is. He's swayed by fear and greed.
Right. So what's the key takeaway here?
The key takeaway is to not let Mr. Market dictate your investment decisions.
Okay.
Don't get caught up in his mood swings.
Right.
Don't let his fear or greed influence your judgment.
So we need to have our own independent assessment of value.
Do your own research. Determine what an asset is truly worth.
Okay.
Regardless of what Mr. Market is offering.
Right. Because he's not always rational.
No, he's often driven by emotions.
So Mr. Market is there to serve us.
He is.
Not to guide us.
That's right. You're in control of your own investment decisions.
I like it.
You don't have to buy or sell just because Mr. Market is feeling particularly optimistic or pessimistic.
So don't let his emotional roller coaster derail your long-term strategy.
Stick to your plan. Focus on the fundamentals and remember, time is on your side when you're investing for the long haul.
I like it. And you know, one thing that can help us deal with Mr. Market's mood swings is to have a written investment plan.
Absolutely. That's a great idea.
Why is that so important?
Well, it forces you to think through your investment goals.
Okay.
Your risk tolerance, your time horizon, your strategy.
Right.
It helps you to clarify your thinking and to articulate your approach in a way that you can refer back to when the market gets turbulent.
So it's like having a roadmap, a guide to help us stay on track when the going gets tough.
Exactly. It helps us to stay focused on our long-term goals and to avoid making those impulsive decisions that we might later regret.
Now, Graham also talks about the importance of being a student of the market, of learning from history and from our own experiences.
Absolutely. He believed that the market is a constantly evolving entity.
Okay.
And that investors need to be adaptable, to be willing to learn from their mistakes, and to adjust their strategies as needed.
So it's not about finding some magic formula and sticking to it blindly.
No, it's about being open to new information, being willing to challenge your own assumptions, and being flexible enough to adapt to changing circumstances.
Right. It's about being a lifelong learner.
Exactly. The market is always teaching us something new.
Okay. And one of the areas where Graham's insights are particularly relevant today is in the realm of technology and innovation.
Oh, absolutely. The world is changing so rapidly.
It's crazy.
New technologies are emerging at an accelerating pace, and it can be really challenging for investors to keep up.
It feels like there's a new next big thing every week.
I know, right? It's hard to separate the signal from the noise.
So how do we navigate this rapidly changing technological landscape as investors?
Graham was a big proponent of technological progress. But he was also wary of those who overhype new technologies.
Right.
And make unrealistic promises.
Yeah, we've seen that happen time and time again.
Oh, yeah, the dot-com bubble is a classic example.
So how do we avoid getting caught up in the hype?
Well, Graham encourages investors to focus on the fundamentals, on the underlying economics of a business, rather than getting swept away by all the excitement surrounding a new technology.
It's about asking ourselves, is this technology creating real value?
Yeah.
Is it solving a real problem? Is it likely to generate sustainable profits over the long term?
Those are the questions you need to be asking yourself.
Right, because not every shiny new object is going to turn into a gold mine.
That's right.
So we need to be discerning.
We need to be critical thinkers.
And we need to remember that margin of safety.
It's always important to have that margin of safety.
Can you remind us one more time what that is?
Sure. So margin of safety is the difference between the price you pay for an asset and its intrinsic value.
So it's like a buffer.
Exactly. It's a cushion that protects you from losses.
And how do we determine that margin of safety?
Well, it involves estimating the intrinsic value of the asset.
Right.
Which, as we've discussed, is not an exact science.
It takes judgment and analysis.
But it's a crucial skill for any intelligent investor.
Okay, now one of the biggest challenges for investors is dealing with those psychological aspects of investing.
Oh, absolutely. The market can be an emotional roller coaster.
Right. It's easy to get caught up in the fear and greed.
It is. We're all human.
So how do we stay level-headed when everyone else is losing their minds?
Well, Graham had some great advice for that.
Okay.
He said one of the best things you can do is develop a set of investment principles.
Right.
And stick to them no matter what.
So have a plan.
Yeah.
And don't deviate from it.
Even when the market is going crazy.
No matter how tempting it might be.
That's right, because when emotions run high, that's when people tend to make their biggest mistakes.
And he also suggests keeping a journal.
A journal of your investment decisions.
So write down why you bought or sold a particular asset.
Exactly.
Right.
That way, you can review your decisions later.
Okay.
And see whether you were acting rationally or emotionally.
So it's about being accountable to yourself.
Exactly. And it helps you to learn from your mistakes.
Right.
Which is essential for becoming a better investor.
Okay. And of course, Graham emphasizes the importance of patience.
Oh, yeah. Patience is a virtue in investing.
Right. We all want to get rich quick.
We do.
But that's usually not how it works.
It rarely is.
So we need to take a long-term perspective.
Exactly.
Ignore the short-term fluctuations of the market and trust in the power of compounding.
Let your investments grow over time.
And diversification is also crucial.
Absolutely. Don't put all your eggs in one basket.
Why is diversification so important?
Well, it helps to reduce risk.
Okay.
By spreading your investments across different asset classes, different industries, different geographic regions.
So if one investment goes sour, it doesn't take down my entire portfolio.
That's right. It's like having a safety net.
And Graham provides some specific guidance on how to diversify.
He does. He suggests investing in a mix of stocks and bonds.
Okay.
With the specific allocation depending on your individual circumstances.
Right.
And he also recommends diversifying across different industries and different geographic regions.
So don't be afraid to look beyond our own borders.
Exactly. There are investment opportunities all over the world.
Now, one of the themes that runs throughout the book is this idea of being a critical thinker.
Oh, yeah. That's essential for any intelligent investor.
Right. Don't just blindly accept the conventional wisdom or the opinions of experts.
Question everything. Do your own research.
Think for yourself.
Exactly. Don't be afraid to go against the crowd.
Especially when it comes to financial news.
Oh, yeah. The financial media can be a real minefield.
So how do we navigate that?
Well, Graham suggests being very discerning about the information you consume.
Okay.
Don't blindly accept everything you read or hear.
So question the motives of the source.
Yes.
Consider the biases that might be at play.
And always do your own research before making any investment decisions based on what you've seen in the news.
So be critical, be skeptical.
Yeah, and remember that the most valuable insights often come from digging deep.
Okay.
Reading those detailed financial reports,
right.
Understanding the nuances of a business, and developing your own informed perspective.
So it's about being an active participant.
Exactly.
In your own financial education.
You're not just a passive recipient of information.
Okay, now one of the things that Graham really drives home is the importance of understanding market history.
Oh, absolutely. He believed that by studying the past, we can gain valuable insights into how markets work and avoid repeating the mistakes of previous generations.
So it's not just about looking at charts and graphs.
No, it's about understanding the forces that drive market cycles. The psychology of investors, the recurring patterns of booms and busts.
So it's about recognizing that those same patterns are likely to play out again in the future.
They often do. Human nature doesn't change.
And we need to be aware of those patterns so we don't get caught up in the hype.
Exactly, or the panic.
Okay, so learn from the past. Be prepared for the future.
And remember that the market has a way of humbling even the most confident investors.
Well said. Now, before we wrap up this deep dive, I want to touch on one more key concept from the book, which is the idea of the intelligent investor as the owner of a business.
Oh, that's a great one.
So it's not just about buying and selling pieces of paper.
No, it's about owning a part of a real company.
So we need to think like business owners.
Exactly. Understand the underlying value of the business. Its earnings potential, its assets, its long-term prospects.
So we're not just looking at the stock price.
No, we're looking at the business itself.
Right, and that requires us to do our research.
Absolutely. You need to understand the company you're investing in.
All right, so think like an owner. Do your research.
Yeah.
And invest for the long term.
That's the Graham approach.
I like it. Well, that's about all the time we have for today.
Time flies when you're having fun.
It does. We've covered a lot of ground.
We have.
But hopefully you found this deep dive into the intelligent investor.
Yeah.
Both insightful and empowering.
Absolutely. Graham's insights are as relevant today as they were when he first wrote the book.
I agree. It's a timeless classic.
And it's a must-read for any investor who wants to achieve long-term success in the market.
Absolutely. So thanks for joining us.
It's been my pleasure.
And remember, the greatest investment you can make is in yourself.
Couldn't agree more.
So keep learning, keep growing, and happy investing.
See you next time.